Accounting lessons, balance sheet equation. So in this introduction, we will go and define what is balance sheet equation. We will also see assets is equal to net worth plus liabilities. So the fundamental accounting equation is assets is equal to capital plus liabilities. In other words, the liabilities can be thought of as comprising of claims of owner, which is nothing but capital, and claims of outsiders, which is nothing but liabilities. In some sense, claims of honor would mean paid up capital plus balance of reserves and surplus, which is same as net worth. So in other words, capital can be expanded as capital plus reserves and surplus. And hence, what we do is we rewrite the balance sheet equation as assets is equal to net worth, which is nothing but capital plus reserves and surplus plus liabilities. Now we will see what are assets and what are capital plus liabilities. So according to the accounting equation, we write liabilities or capital plus liabilities, we group them together, and assets are grouped in a different way, but together. So what are the common assets? Cash is an asset, bank is an asset, bills, receivables, which are whatever receivables a firm has, which is also under bills, receivables. Debtors is an asset because those people who have to pay the firm some money or cash becomes debtors. Stock in trade, furniture is an asset, machinery is an asset, and building also is an asset. On the capital plus liabilities, or on the liability side, we list owner's equity, outsider's equity, reserves and surplus. So owner's equity is nothing but capital, reserves and surplus, whatever it is, which is net worth. Creditors, money which we have to be paying them, which is creditors, which may be a liability. Bills payable, outstanding expenses, and bank overdraft. So everything is listed under liabilities or under capital plus liabilities. Now let us try to illustrate this concept by taking an example. Here what it is Mr. Ravi starts a business with 20,000 as capital. So how do you actually chart out the balance sheet? That is what we are trying to illustrate with this example. So here what we do is, as we have gone through the previous slide, capital plus liabilities, we list it under liabilities on the left hand side. What is the amount which is under liabilities is the next column, and the assets are grouped on the right hand side with the amount. So here in this transaction, Mr. Ravi starts a business with rupees 20,000 as capital. Ravi's capital is basically rupees 20,000, which is now actually it's an owner's equity or capital, or we actually merely put it as Ravi's capital, which is rupees 20,000. And what is the asset? Ravi has given 20,000 to the firm, and the firm now has cash, which is rupees 20,000. So that is basically an asset for the firm. Next transaction is business purchases machinery worth rupees 1,000. So how the firm has purchased machinery? Firm has purchased machinery by taking cash from whatever Ravi has given as capital to the firm. So 1,000 rupees, the asset, if you really see, we have to reduce 1,000 rupees because 1,000 rupees is taken for purchasing machinery. So the cash asset which the firm has is now only rupees 19,000, and then there is an extra asset which is machinery, which is rupees 1,000. So the total asset remains to be rupees 20,000, and Ravi's capital we have which is as per the previous transaction, it is rupees 20,000, and it tallies. The next transaction is the business purchases goods for rupees 2,000 and the payments are made in cash. Since it's a cash payment, again the cash gets reduced by 2,000. So cash becomes 17,000 because the 2,000 we have to deduct it. And what has the business done with it? It has got goods worth rupees 2,000. So the stock of goods, which is again an asset, which is why we are listing it under assets, which goes up by 2,000. The net assets will be rupees 20,000 and the net liabilities, which is owner's equity, which will be again rupees 20,000, which tallies. The next transaction is goods are purchased by the business on credit for rupees 5,000. So here what the firm has done, firm has gone to a supplier. If firm has gotten goods from the supplier or materials from the supplier, it's actually goods, so goods from the supplier for rupees 5,000. And so what happens is the stock of goods now goes up by 5,000, which becomes rupees 7,000. And since the firm has gotten goods worth rupees 5,000, creditor we have to include as a liability on the balance sheet for rupees 5,000. So the total assets goes up by 25,000, goes up by 5,000 and becomes 25,000. But the goods are bought on credit, so the creditor appears as a liability on the balance sheet. So, and both the liabilities and the assets tally at rupees 25,000. The next transaction is the business now sells goods on credit for rupees 5,000 and the sales have involved some cost termed cost of sales, which is rupees 3,000. So here the business has sold goods on credit. So what exactly is that we are looking at? We have to see how much profit the firm has gained. And now that is gotten by taking the difference of goods which are sold for 5,000 minus cost of sales, which is 3,000. So 2,000 is the net profit which the firm has got, and we will put it as reserves and surplus. So it goes up by 2,000, which is actually listed in under liabilities or liabilities and owner's equity. So reserves and surplus goes up by 2,000. And the stock, and now the business sells goods on credit. So which actually means it is 5,000, which basically the firm has to get from a debtor. So there is a new entry, debtor under assets, where it actually shows 5,000. The next transaction is business pays rent, that is rupees 500, and wages rupees 500. So both are cash payments. So the cash goes down by again 1,000, which becomes 16,000. And the reserves and surplus, basically we have to deduct that because that is taken from whatever surplus the firm has. So 500 plus 500, 1,000 is taken out from reserves and surplus. And the amount which gets tallied between liabilities and assets is 26,000 rupees. So this wraps up a session on balance sheet equation. Thank you.